where we take these complex market analysis reports, we try to strip away all the noise and just hand you the most crucial insights.
Yeah, and today we're looking at a really fascinating case. It's a company called Shoals Technologies Group. Ticker is SHLS.
And it's a perfect example of a financial paradox. I mean, what we're trying to decode here are these two extremely loud signals that are pointing in completely opposite directions.
Exactly. On one hand, you've got a stock price that just took a sharp, really significant hit in a single day.
And then on the other.
On the other, you have a business with absolutely soaring year-over-year revenue growth. It's the perfect disconnect.
It really is. So the core question from the analysis report we're unpacking is this. Is that short-term drop in the stock price a sign of some, deep underlying weakness?
Or is all that fear just masking what the fundamentals suggest could be a golden opportunity?
That's the key. And understanding this pattern, this gap between the price and the business is so crucial for staying well-informed.
It is, because if you only look at that closing price, your gut instinct is just to panic, to sell.
But if you only look at the financials, you might miss a real shift in the market.
The value is in putting both together, understanding why that gap exists in the first place. And that's what we're going to try and do right now.
Okay, so let's start with the immediate pressure point, the short-term data that made everyone so nervous. It was a really rough day for Shoals Technologies right before this report came out.
It was. I mean, visually, the chart just signaled distress. The stock closed down 4.35% on the day.
And it finished right near the bottom of its range at, what, $8.57?
That's right, $8.57.
Yeah.
And the trend all day was it was brutal.
It opened near $9, right? Around $8.97.
Yeah, and then it just steadily slid all day long, closed right at that low. If you were only looking at that one day's chart, you'd assume the company just announced terrible news.
Right, like they lost a massive contract or something that just screams, get out now.
And that creates this instant, powerful sense of fear. The analysis report suggests the market's just acting nervous, and it might not even be specific to Shoals.
So it could be broader sector weakness.
It could be broader volatility in the whole solar sector, which has been, a bit up and down lately. Or it could just be year-end profit-taking.
Ah, the classic year-end shuffle.
Exactly. Institutions locking in gains, shedding some risk before the year closes, and sometimes, the baby gets thrown out with the bathwater.
So that fear is contagious, quantified by that 4.35% loss. But this is where the conversation gets really interesting.
It does, because the market action is screaming struggle, but the analysis explicitly says this daily price move is, well, totally divorced from the company's actual performance.
Okay, so if the price action is screaming distress, what proof does the report give us that the company is actually, thriving?
Well, that brings us right to the core financials of the company. This is where that price drop might actually be the gift that the report mentions.
A gift because you could potentially acquire a growing asset on the cheap.
Precisely. We need to look at the latest Q3 numbers, and the speed of their growth is pretty staggering.
So the financials tell a very different story from that one-day trade.
A much deeper, more complex story. Go ahead, give us those revenue figures.
Okay, so revenue is surging. Shoals posted $135.8 million in revenue in their latest quarter.
Which is a powerful number by itself.
It is, but the figure that really jumps off the page is the growth rate. That revenue is up a massive 32.9% compared to the same period last year.
32.9%. I mean, think about that for a second.
That's a high-growth company.
That's a classic high-growth trajectory. That's the kind of number you usually see from a hot new tech company, not necessarily a company making electrical components.
Right. And when you see a company growing at nearly 33%, but its stock price is signaling distress, that is the definition of a deep disconnect.
The stock chart says weakness. The financial statement says explosive expansion.
So for the learner out there, past revenue is great, but investors want to know about the future. What metrics should you prioritize to sort of guarantee future activity?
This is where we look past the revenue that's already been booked and focus on what they call the fortress backlog.
Okay, and what does that number look like?
It's a record backlog of $720.9 million.
Wow, $720.9 million.
So that's nearly $750 million in signed guaranteed orders.
Correct. And these aren't just, pipeline projections or potential leads. These are contracted sales. It's guaranteed future revenue.
Which gives them a really long runway for growth, regardless of what the market does on any given day.
It's financial proof. Proof that the demand for their product is robust and it's already locked in for years to come.
And here's the other key point, the counter argument to all that fear. They're not just, burning cash to get this growth. The analysis highlights their profitability.
Absolutely essential point. They posted an adjusted EBITDA of $32 million. Okay, so let's break that down for a second. EBITDA earnings before interest, taxes, depreciation, and amortization. Why does that matter so much here?
Because it gives us a really clean look at their operating profitability. It tells you how efficiently the core business is running, before all the messy accounting and financing costs.
So if they're growing revenue by 33% and posting solid EBITDA, what does that combination tell us?
It tells us the expansion is sustainable. They aren't just bleeding cash to chase that 33% growth. They have a viable, profitable business model that's supporting that gigantic backlog.
High growth with solid profits, that's a rare signal.
It's a very rare and highly prized signal, especially in a capital-intensive sector like solar infrastructure.
Okay, so the fundamentals are incredibly strong. We've got 33% revenue growth, a $720 million backlog. So why is this company positioned so well? This gets to their strategic advantage, right?
Right. They aren't just another solar company competing on commodity prices.
That's the key distinction. When most people hear solar, they immediately think of the big panels themselves. But Shoals doesn't even make the panel.
They don't. They make what's called the EBOS, the electrical balance of system.
So that's all the other stuff, the specialized wiring, the fuses, the connectors, everything that actually makes the solar farm work and connect to the grid.
And that niche puts them in this really desirable role. They are the picks and shovels of the energy gold rush.
I love that metaphor. It's so clear. In a gold rush, you don't want to be the one digging for gold. You want to be the one selling the picks and shovels to everyone.
Because it doesn't matter who finds the most gold. It doesn't matter which company makes the cheapest panel or the most efficient one.
They all still need your tools.
They all need your specialized wiring and connectors. You don't have to worry about the volatile price of the commodity. You just sell the essential infrastructure.
So it gives them a certain degree of pricing power and structural importance. They're just essential.
Precisely. Now we have to connect that great business model to the bigger picture, the macro trends.
Right, because solar is a hugely capital-intensive industry.
Extremely. When a utility decides to build a, let's say, $300 million solar farm, they are relying heavily on project financing.
Which means interest rates are basically the throttle for the entire industry.
They are the ultimate throttle. When the Fed raises rates, the cost to borrow that $300 million just skyrockets. New construction slows down.
Or stops completely. If the math doesn't pencil out, the projects just stall.
Exactly. But if that lending rate drops from, say, 5% down to 3%, suddenly billions of dollars in projects that were stalled become economically viable overnight.
And the analysis report highlighted this as a major factor, didn't it? The expectation of incoming rate cuts, probably moving into 2026, is a huge part of the bull case for Shoals.
It's the central pillar of the long-term bull case. Those rate cuts will unlock a tremendous wave of cheaper financing for new solar construction.
And when that happens, the whole sector just accelerates.
It accelerates rapidly. And Shoals, with its specialized components and that huge existing backlog, is just perfectly positioned to ride that wave.
So they get to fulfill all those new orders no matter which company actually wins the panel contract?
It's the infrastructure play on the energy transition. They get all the upside of the clean energy boom without taking on the direct commodity price risk of the panel.
So you've got a great business model, explosive growth, and a huge macro tailwind on the horizon with potential rate cuts.
It's very difficult to argue against the long-term health of that business.
Which brings us right back full circle to this bizarre valuation disconnect.
Right. We have this emotional price action, the stock falling 4% in a day, driven by fear.
But then you have the fundamental surging 33% for the year, reinforced by that, nearly $750 million backlog.
And this is where the rubber meets the road. This is the learning opportunity. The current trading price is hovering right around that recent low of $8.50.
So you have to compare that price, driven by daily fear, to what the professional analysis says.
And what are analysts projecting for where the stock should be trading, given everything we've just talked about?
Well, the analysts are consistently projecting a price target north of $11.
North of $11.
Yeah.
So that raises a really important question you have to wrestle with. If the stock just goes from $8.50 back up to $11.
You're looking at an upside of 20 to 30% just to get back to what analysts consider its current fair value.
It forces you to think critically. Do I trust the visible, contagious fear from one bad day in the market? Or do I trust the financial statements showing a company growing like a weed and booking hundreds of millions in guaranteed future work?
That's the mental hurdle, isn't it? It takes some confidence to buy a stock that just dropped 4%. People worry it's a falling knife.
Of course. But given the strength of the fundamentals, that 32.9% growth, the solid EBITDA, the massive backlog, the analysis strongly leans toward this just being an entry point driven by irrational short-term fear.
So wrapping this all up, what's the core insight here? The biggest takeaway for anyone trying to cut through all the market noise?
I think it's that the market can be highly emotional. It can be driven by these very temporary factors,
Yeah.
like year-end profit taking.
But the company's actual records, the documented financials, they tell an undeniable story of rapid and, more importantly, secured expansion.
The analysis focuses on two very different timeframes, and that's what you need to internalize. It contrasts the extreme volatility of a single day, that 4% drop, with the sustained operational growth of the fiscal year, that 33% revenue surge.
It's a fantastic illustration of why getting caught up in the minute-by-minute price swings can just completely obscure the business reality.
Day traders care about the daily close. Long-term thinkers care about the secured contracts.
Right, and that leads directly to the final provocative thought we want to leave you with.
How often does this daily market noise distract us from businesses that are, fundamentally breaking records and securing their future? And what specific metrics truly serve as the best predictors of long-term strength? Is it that $8.57 closing price? Or is it the $720 million guaranteed backlog that tells the real story?
That's the difference between just reacting to the market and actually investing intelligently in a business. Thanks for diving deep with us.